The financial world is currently fixated on a singular figure whose name has become synonymous with catastrophic foresight, a man who famously stood alone against the thundering herd of the mid-2000s and emerged not just vindicated, but legendary. Michael Burry, the physician-turned-investor who served as the central protagonist of the subprime mortgage collapse saga, has re-emerged from the shadows of his private research, with a warning that makes his previous predictions look like minor corrections. He is sounding the alarm on what he characterizes as the most significant financial bubble in human history, an interconnected web of exuberance involving artificial intelligence, the traditional stock market, and the digital frontier of Bitcoin. Burry's thesis is built on the premise that we are currently navigating a landscape defined by circular financing and unbridled hype, where a tiny handful of massive technology companies are essentially acting as the structural pillars for the entire global economy. According to his analysis, when these pillars eventually buckle under the weight of their own overvaluation, the resulting collapse will drag down every speculative asset in its wake, including Bitcoin, which he has provocatively labeled as being in a state worse than the Dutch tulip mania of the 17th century. To back his conviction, he has reportedly placed billion-dollar bets against industry giants like Nvidia and Palantir, reviving his Cassandra persona to signal a coming storm that he believes most are choosing to ignore. However, before an investor chooses to liquidate their holdings based on this grim prophecy, it is essential to perform a deep architectural audit of Burry's career, his specific investment framework, and his actual track record following his 2008 triumph. Because this isn't merely a discussion about market movements, it is a study in the limitations of even the most brilliant analytical models. To truly grasp the weight of Burry's current stance, one must first deconstruct the origin story of the man himself, moving past the cinematic portrayal to understand the cold, calculated logic that defines his process. Michael Burry did not stumble into fame through a lucky guess or a macroeconomic coin flip. He was a man of immense discipline and intellectual rigor who began his professional life not in a bank, but in a hospital. Trained as a neurologist, Burry applied a diagnostic, clinical lens to the world of finance, eventually becoming obsessed with the school of value investing. This discipline, pioneered by Benjamin Graham and popularized by Warren Buffett, demands an exhaustive line-by-line interrogation of balance sheets, cash flow statements, and SEC filings. In the late 1990s, while still a medical resident, Burry began sharing his deep, fundamental analysis on internet message boards, attracting the attention of seasoned professionals who were stunned by the depth of his insights. By the time he launched Scion Capital in 2000 with a relatively modest sum of family and seed money, he had already established himself as a practitioner of deep value, an investor who looked for the intrinsic worth of a company completely independent of market sentiment or popular trends. In the early years, from 2000 leading up to the Great Crash, Burry's performance was undeniably stellar, averaging annualized returns of roughly 26% and outperforming the broader market by a staggering margin during a period when many were still reeling from the dot-com bust. Yet, it is a common misconception that he was an oracle of macro trends during this time. In reality, he was a disciplined stock picker, someone who excelled at finding undervalued gems in the rubble of the market. He wasn't trying to break the Bank of England or predict global shifts in monetary policy. He was simply reading the numbers that others were too lazy to scrutinize. His legendary status was not built on a decades-long streak of flawless calls, but rather on a single high-stakes trade that almost cost him everything. This is the part of the story that often gets sanitized. The Big Short was not a clean or easy victory. It was a brutal, near-fatal gamble characterized by terrible timing and immense psychological pressure. Around 2003, Burry's obsession with data led him into the weeds of the residential mortgage market, where he discovered a terrifying structural rot. He saw the rise of no-documentation loans and teaser rates that were destined to reset into defaults. Recognizing that the housing market was structurally broken, he pivoted nearly the entire Scion portfolio into credit default swaps against subprime mortgage bonds. This was a move of unprecedented aggression, using custom, illiquid derivatives that required him to pay massive annual insurance premiums just to keep the bet alive. Because he was nearly 2 years too early, he found himself in a position where he was bleeding cash to the tune of $20 million to $30 million a year, while the housing market continued to climb and the S&P 500 reached new heights. To the outside world, and especially to his investors, Burry looked like he had lost his mind. By 2007, his fund was facing a revolt. Over 90% of his investors wanted their money back, but because he was locked into these illiquid trades, he took the drastic and legally precarious step of freezing redemptions. He was sued, mocked, and pushed to the brink of financial ruin. Only the eventual, once-in-a-generation total collapse of the global financial system saved him. Had the timing of the Lehman Brothers collapse shifted by even a few months, Burry might have gone down in history as a failed eccentric rather than a visionary. This experience in 2008 fundamentally shaped the investor we see today, but it also highlights a critical flaw that has plagued his post-crash career. After shutting down Scion for a period to recover from the emotional and legal exhaustion of the crash, Burry returned to the arena, but the world had changed in a way his framework could not account for. Since 2010, Burry has remained almost perpetually bearish, trapped in a cycle of predicting disasters that fail to materialize or occur much later than he anticipates. In 2010, he warned of a double-dip recession that never came. The market finished up 15%. In 2015, he predicted a China-led global collapse. The market wobbled but recovered. In 2017, he warned that rising interest rates would cause a total meltdown, only to watch the S&P 500 rally by nearly 20%. Perhaps most famously, he called index funds the next subprime crisis in 2019, yet the markets continued to post historic gains. His massive short against Tesla in 2020 resulted in him missing a 700% rally, and his billion-dollar bet against the S&P 500 in 2023 was met with a 20% surge in stock prices. The data suggests a troubling pattern. From 2014 to 2023, Burry's fund consistently underperformed the S&P 500 by a significant margin. If an individual had followed his advice during this decade, they would have missed out on one of the greatest periods of wealth creation in history. The question then becomes, why does a man so smart get it so wrong for so long? The answer lies in the conflict between his Benjamin Graham-style value framework and the new reality of the global economy. Burry's model relies on intrinsic value, earnings, and stable money. However, since 2008, the global markets have ceased to be driven by fundamentals and have instead become slaves to liquidity and central bank intervention. While Burry looks at balance sheets, the market moves based on the expansion of the money supply. This is why his perspective on Bitcoin is so fundamentally skewed. Through the lens of a value investor, Bitcoin has no cash flow, no dividends, and no physical assets, so it must be a bubble. He compares it to tulips because tulips had no utility beyond their aesthetic. But he fails to recognize that Bitcoin is not a decorative asset. It is a piece of global financial infrastructure. Bitcoin was never intended to be priced like a traditional stock. It is a decentralized, neutral, and scarce monetary layer designed to function in a world where fiat currencies are being systematically diluted. While Burry sees tulip mania, proponents of the digital asset see a technological solution to the Byzantine general's problem and a hedge against the very debt-driven system that Burry himself despises. By calling Bitcoin a bubble, he is revealing the boundaries of his own map. He is using a 1930s framework to try and navigate a 21st century digital landscape. This is the heart of the framework story. When an investor becomes too attached to a specific way of seeing the world, they often ignore the evidence that the world has moved on. The danger of following a figure like Burry is that his brilliance makes his pessimism sound like undeniable truth. In the world of finance, the person who sounds the most cynical often sounds the smartest. But the markets do not reward the smartest sounding person. They reward the one who understands the underlying structure of the system. Currently, that structure is built on debt, currency expansion, and the weaponization of the financial system. In such an environment, assets like Bitcoin and even high-growth tech stocks behave in ways that traditional value models simply cannot explain. Instead of reacting to the headlines of a Cassandra call, the modern investor must ask whether they are operating with a system of their own, or if they are simply outsourcing their confidence to a celebrity contrarian who happened to be right once 20 years ago. Investing is not about being right on a single dramatic call. It is about building a robust operating system for your wealth that can withstand various weather patterns. It is about understanding that while Burry's math might be technically correct regarding overvaluation, his conclusion is often wrong because he underestimates the power of human progress and the sheer volume of liquidity that keeps the engine running. Real financial sovereignty comes from having a framework that allows you to stay disciplined during the hype and composed during the panic, rather than jumping from one expert's doomsday prophecy to another. As we look toward the future, the challenge isn't to decide if Michael Burry is right or wrong this time. The challenge is to stop being a reactor to the news and start being an architect of your own financial reality. The biggest mistake isn't being wrong about a specific asset. It's having no system at all and being forced to follow the whims of those who are perpetually betting against the future.